A share of Apple stock cost about 29 cents in 1980. Today, adjusted for splits, that same share is worth over $190. That's a 65,000% gain. But here's what nobody explains. Where did that money actually come from? It didn't just materialize. Understanding this changes how you think about investing entirely. The stock market makes you money in exactly two ways. First is price appreciation, also called capital gains. That's when you buy a share for $50 and sell it later for $75. The $25 difference is your profit. Second is dividends. Some companies take a portion of their profits and distribute it directly to shareholders. These are cash payments that land in your account, usually every quarter. Most stocks use one or both of these methods. Growth companies like Tesla typically don't pay dividends because they reinvest everything into expanding. Mature companies like Coca-Cola pay regular dividends because they generate consistent profits. Looking at the S&P 500 over the past century, the average annual return has been about 10%. But here's the breakdown. Roughly 6 to 7% comes from price appreciation, and 3 to 4% comes from dividends. That dividend portion might seem small, but it compounds. Over 30 years, reinvested dividends can account for nearly 40% of your total returns. This is why dividend-paying stocks remain popular for long-term investors. So why does a stock price actually increase? It comes down to supply and demand. But what creates that demand is expectations about future profits. When a company reports strong earnings, launches a successful product, or enters a growing market, investors believe future profits will be higher. More people want to buy the stock, so the price rises. The opposite happens with bad news. This is why stocks are sometimes called forward-looking. The price today reflects what investors think the company will earn tomorrow, not just what it earned yesterday. Sometimes those expectations are accurate. Sometimes they're wildly off. Take Microsoft in the early 2000s. The stock traded around $25 for nearly a decade, barely moved. Then in 2014, new CEO Satya Nadella shifted focus to cloud computing with Azure. Over the next 8 years, the stock climbed from $40 to over $300. The company's actual profits grew significantly during that period, and investors kept raising their expectations higher. Someone who bought $10,000 of Microsoft stock in 2014 saw it grow to roughly $75,000 by 2022, purely from price appreciation. The company also paid dividends throughout that time. Dividends work differently. When a company declares a dividend, they announce a payment per share. Let's say you own 100 shares of a stock, and the company declares a 50-cent dividend per share. You receive $50, typically deposited directly into your brokerage account. You don't have to sell anything. The company is literally giving you a portion of their profits. The dividend amount is decided by the company's board of directors. Some companies increase dividends every year. Others cut them during tough times. Companies aren't required to pay dividends at all. Many choose not to. There's actually an index called the Dividend Aristocrats. These are S&P 500 companies that have increased their dividend payments every single year for at least 25 consecutive years. There are currently 67 companies on this list. Names like Johnson & Johnson, Procter & Gamble, and McDonald's. The average dividend yield for these companies is around 2 to 3% annually. For income-focused investors, these stocks provide predictable cash flow. Here's a critical distinction. If you buy a stock at $100 and it rises to $150, you haven't actually made money yet. That $50 increase is called a paper gain or unrealized gain. It only becomes real money when you sell the stock. Until then, the price could go back down. This is why some investors talk about taking profits. They're converting paper gains into actual cash. The same concept applies in reverse. If your stock drops 20% but you don't sell, that's a paper loss. It only becomes a real loss when you sell at the lower price. Many investors use a strategy called dividend reinvestment. Instead of taking dividend payments as cash, they automatically use that money to buy more shares of the same stock. Most brokerages offer this as a free feature called a DRIP, which stands for Dividend Reinvestment Plan. Over time, this increases the number of shares you own, which means you receive even more dividends next quarter. This compounds your returns. Someone who reinvested dividends in the S&P 500 over the past 30 years would have significantly more wealth than someone who just took the cash. There's also a tax angle. Capital gains from stocks you've held longer than a year are taxed at lower rates than ordinary income. For most people, that's 15% versus potentially 22 to 32%. Qualified dividends receive the same favorable treatment. Short-term capital gains from stocks held less than a year get taxed as ordinary income. This is why many financial advisors emphasize holding investments for the long term. The tax savings alone can boost your effective returns by several percentage points annually. Both sources of profit come with risk. Stock prices can fall just as easily as they rise. Companies can cut or eliminate dividends during financial trouble. During the 2008 financial crisis, hundreds of companies slashed their dividends. Many stocks lost 50% or more of their value. Some investors panic sold and locked in those losses. Others held on or bought more at lower prices. By 2013, the market had fully recovered. This is the fundamental trade-off with stocks. Higher potential returns come with higher potential losses. The longer your time horizon, the more time you have to weather downturns and benefit from long-term growth trends. This all connects back to why companies issue stock in the first place. When a private company goes public through an IPO, they're selling ownership stakes to raise capital. That money funds expansion, research, hiring, acquisitions. In exchange, shareholders get a piece of future profits through price appreciation and potentially dividends. It's a win-win when the company succeeds. Shareholders profit, and the company gets funding without taking on debt. When the company struggles, shareholders bear the loss. This is the core mechanism of capitalism. Capital flows to businesses with growth potential, and investors share in the upside and downside. So, to recap, the stock market makes you money through price appreciation and dividends. Price appreciation happens when investor expectations about future profits drive demand higher. Dividends are direct cash payments from company profits. Paper gains only become real when you sell. Reinvesting dividends compounds returns over time. Long-term holdings get better tax treatment. And all of this comes with volatility and risk. Understanding these mechanics is fundamental to making informed investment decisions. It's how wealth gets built in the market, one share at a time. Everything covered here is for educational purposes only. This is not financial advice. Every situation is different. Consider speaking with a licensed financial advisor before making any major money decisions.